Thanks for a little bit of time. We've got a very quick 20 minutes. My background, I've been, believe it or not, in the inkjet printing industry for about 30 years. Started as an engineer, started a few inkjet companies. The last one was a company called Jetreon that was focused on the digital packaging and labeling space. Sold that to EFI in 2006, 2007. Worked there for 4 or 5 years in their management team. Attempted retirement. Turns out that's a lot harder than you would think. And quite accidentally started a company called Proximus that's focused on M&A within the digital print world. I've done about approaching $1 billion worth of inkjet deals over the last 7 or 8 years. So, better lucky than good to be in the right spot at the right time. Our industry's consolidated quite a bit since 2012. So today I'm going to give you a quick update on digital printing M&A. My talk's going to be a little bit more granular, I think, than the ones that you've seen so far. Those were great to sit through and learn a little bit about leadership and about macro issues. I will talk about some macro issues, given the short time frame and also some fairly desperate calls from a couple of boards that I help out. I'm really going to focus in on one macro issue, which is inflation and rising rates, and how that really affects our printer sales, okay, and printer OEMs, because to be honest with you, the ground is moving under our feet on this issue right now, particularly in North America, coming to Europe, so we'll talk about that. So I'm going to speak very quickly, apologize, but we've only got 20 minutes. I keep a huge data set of all of the inkjet printing deals since 2012 for my clients. It really focuses in, again, on industrial inkjet printer, at least certainly the data I'm going to show you here. So it excludes things like 3D and bio, really focuses in on things like wide format, ceramics, textile, et cetera, et cetera. All the deal values, and I'll talk about it from public records. Obviously, I know a few others along the way as well, but we'll talk about things like multiples and how things are going. But I think this is really interesting in terms of how an industry is faring, right? Because M&A is a very important part of our industry. Our industry is consolidated a lot. In the upper right-hand corner, we see a graph. The vertical column there is simply deal count. Okay, it's not deal value, but deal count. And we can look at things as like value as well, but I think deal count is really indicative of how healthy sort of M&A and consolidation is. And in this case, I've split it out by what type of company was sold. Was it a printer company, a systems company? Was it an ink company? Was it a software company? Or was it other? Others, things like finishing equipment and things that don't quite fit. And we see in 2012, the industry was pretty young, digital print, so we start to see some consolidation. 2014, 2015, 2016, things got really aggressive. This was the real boom for industrial inkjet. This is when it went from sort of a technology that people thought might work. It really became in the mainstream. Things like textile and other things were really exploding there. What's interesting is if you look back in sort of 2015 and 2016, the entire inkjet ink industry consolidated within 2 years. Okay, and what was happening there was a lot of the larger printer companies realized, hey, ink's pretty important, right? I can't depend on a third party. I had supply disruptions. I was worried about margin. So the ink industry in 2015, 2016 really began to consolidate. Now, what's happened from 2016 on is, the number of deals per year has been kind of flat, right? And we have a huge problem here within the digital print industry is we don't have a great ecosystem for startups. Okay, we don't see a lot of startup activity in the industrial inkjet world. Why is that? Well, quite frankly, funding hardware projects is very hard nowadays. I can get you money to go build a software company with about 2 phone calls. Try getting a few $1 million to start a printer company these days. It's a lot harder, except maybe in places like Israel. Secondly, there's been a lot of consolidation by some of the big guys. So what we saw was things were kind of flat. 2019, sort of 2019, 2020, COVID hit, and you look and you say, well, geez, the M&A activity actually kind of held up, which makes sense, right? Because those deals take 6 to 12 months to happen. So deals that started in 2019 finished in 2020, but then we saw a huge drop off in 21, right? Really from COVID. But 2022 is going to be a massive record year. Okay, through June, we've already equaled 2020, 2019, and 2018. Okay, and if I project sort of correctly, I think we're going to probably get up to 15, 16, 17 deals this year. Okay, so really aggressive. Just to kind of keep moving, same deals, but this time split in terms of where the deals are. If we look, vast majority of the deals in our industry are in Europe. Okay, which makes sense, right? Europe is the cradle of industrial inkjet, right? You've got places like Cambridge in Germany and most of the OEMs are here in Europe. In the US, I'll be honest with you, it's almost impossible to fund hardware companies. Okay, Europe, Israel, much easier. In terms of people always ask about valuations, how are valuations going? You know, the valuations in our markets have been really pretty stable now for 5, 6, 7 years. I've done it here off of revenue multiple. We can certainly do it off our earnings multiple as well. Systems companies, again, printers, you know, companies that sell and develop printers, you know, between 1.5 and 2 times revenue has been pretty typical. That's been very consistent. Earnings-wise, you're talking 8 to 12 times earnings, so very healthy. Very similar, by the way, to a lot of other high-end tech markets like electronics, robotics, things like that. We're very similar. Inc., 2 to 5 times revenue. Could be 15, 20, 25 times earnings. Why? Well, huge high margins. Okay, if you look at the specialty chemical industry, same exact kind of multiples. Again, very, very stable. Very few Inc. companies left, though. Okay, software, always high margins, obviously, right? Great scalability. OEM and components, and this one is really interesting. We'll talk about it in more detail in a second. These are people that build, say, ink systems and electronics and things like that. This includes things like integrators, people that take print heads and ink systems and put them together for custom projects or things like that. Much lower multiple, right? Let's say 0.7 to 1 times revenue. Earnings, you're talking about 4, 5, 6, 7 times earnings. So sort of on the low side. Why? They're really hard to scale, right? They tend to be small companies, but sometimes they have extremely critical resources that larger companies need. And in fact, what's really, and I'll talk about it in a second, that bottom area has actually been one that's been really consolidating over the last 12 months. So I'll talk a little bit about the landscape, okay? And a lot of this also sort of feeds back into how are these different markets doing. Wide format graphics, great market, it's huge, but it's relatively flat, okay? We don't see a lot of merger and acquisition activity here. Some tuck-in acquisitions like Durst buying Vanguard in the US. Textile roll-to-roll, you know, 5, 6, 7 years ago, this was the hottest market around, okay? Both in terms of growth, in terms of revenue, in terms of margin. You know, that's one that's really gotten hit by COVID. How many new Hermès ties are you buying? Does anybody wear a tie today? Is there anybody in a tie? Okay, well, there you go. So roll-to-roll textile has had a tough time, and again, there's been a lot of consolidation there. I don't see a lot more. There may be some, but that's going to be a rough area. Labels has been a great business, very near and dear to my heart. Been growing very rapidly, but very few targets. Okay, there's very, very few label companies that have not been consolidated yet. Direct-to-garment and promotional, that's going to be a big area over the next couple of years. There's a couple of really nice smaller companies out there. You're going to see those guys get consolidated almost for sure. Laminates has taken a while. You know, we, again, don't have a lot of startups on the laminate side. Lots of interest. Okay, so a couple of really small ones, but been a little tough. The one I'm really excited about, I think Mr. Kennedy is going to be giving a talk about this later today, is direct-to-shape or direct-to-product markets. This one is the exception to the rule. We've got 5 or 6 or 7 startups now, okay, in the US and in Europe, all going after direct-to-can, direct-to-bottle. Great ESG story, okay? Shrink wrap labels will get legislated out of our lives. Already been done in Canada. You can't wrap a metal can with a shrink wrap anymore. Destroys recyclability, okay? That's coming everywhere. Direct-to-shape finally works, okay? That's going to be a really great area. Flex pack, everybody wants it. You know, there aren't a lot of startups there. Corrugated, same thing. Ink, lots of interest in ink companies, but to be honest with you, no targets. Software, lots of activity over the last few years. Will continue. Components and OEM, specifically, kind of tough. Okay, kind of tough. There's just not a lot of buyers for those unless someone's very specifically looking for something. Integrators, though, that's the biggest change. When these guys would come, again, these are companies that build sort of bespoke systems. They would approach them and say, hey, Ken, look, you know, can we start a process? You know, I decided I need some more investment capital. Hey, I'm getting a little older, want to sell the company, don't have a child to give it to. I used to say, hey, you know, good luck, man, but it's tough. Now, number one area. Okay, just in this year, right? You've got Zard doing a bunch of buys. You've got Fuji. You've got Canon, right? Why? Because particularly the printhead companies are very interested now in building full systems, particularly bespoke systems for specific applications. So that's going to be a huge change in our little world, okay? Huge change. So That's a very, very fast version of about a 2-hour talk. So we'll move on very quickly to one macro area. And I was going to give you a longer talk on macro issues that I discussed with some of my board clients on, globalization and reshoring and all that sort of stuff. But we have a short period of time, and over the last 3-4 weeks, I've gotten 2 phone calls from boards about inflation and in particular rates and what it means to the printer company, right, when we're selling printers. So one of the things that's happening, particularly in North America, is credit spreads are blowing out. What does that mean? Well, if we're selling a printer $200,000, $300,000, $400,000, $500,000, one question I always ask, in fact, I asked it of a VP of sales the other day, I said, well, what percentage of your customers are financing that purchase, right? He said, oh, we get involved 5%, so rates don't matter for us. I said, well, that's not what I asked you. I said, your customers, I said, what percent of them are using financing to purchase these large printers? Okay. Well, it turns out it's 50, 60, 70%, right? So when rates rise, what happens, right? So I think one bet that we can all make, and I have no idea if we're going to have a recession or a soft landing or a hard landing, and I don't think Powell or Lagarde or anybody else knows, but I can always guarantee you rates are going to continue to rise. Okay. Well, 2 things happen, right? One is that credit spreads, okay, the difference between whatever the reference rate is, the prime rate or the 10-year or whatever, and the actual rate that a customer pays, right, on their loan, those things start to blow out. But they do it in a very nonlinear fashion, right? Customers that have a lot of creditworthiness, they'll see a little bit of a gain, right? Or a little bit of a change. But the ones that have low creditworthiness, they see a huge change. So today in North America, credit spreads on the lower tranches of creditworthiness are almost double where they were 4 months ago. Almost double. I predict, and I'll bet you a beer, particularly one of Fraser's free beers afterwards, that if we go out another 12 months, they're going to double again. Right? So 2 issues here, right? 2 issues here, okay? So, well, again, the way these lenders think about it, though, to them, this isn't such a bad thing, right? Because they make money off the spread. So when the spread doubles, right, like it does for the low creditworthy customers, they can do half the loans, make the same amount of money, right? In fact, they can actually make a little bit more money. In fact, the funny thing is if you look at data on defaults of industrial equipment, they're almost the same, recession or not. Right? So the lenders aren't actually that upset at all this, right? So, but what does that mean for us? What does that mean when you're out selling equipment, okay? And one key thing, and this is a thing I've been working on with my clients, is which is the bigger effect, right? Is it the fact that the rates went up, right, to that end user, that buyer of a printer, or is it access to credit, right? Which one? Now, they're both important, right? So it's interesting to me because a lot of product managers, sales ops folks, they get really focused in, okay, really focused on the effect on the ROI, right? They've got this beautiful 40-page ROI spreadsheet, and it's got everything in there and all the savings and then the ROI. How many customers that are in tranche D do an ROI? Be honest with me. Not a lot, right? And plus, that customer, they kind of know their business, right? They say, hey, if I add one more of your printers, I know I've got business for this many customers. Forget the ROI. I don't care if I'm paying 15 points or 20 points. I've got the business for it. So the real issue that you've got as a printer OEM is access to credit. How do you help your customers get access to credit when credit spreads blow out, right? It's not really the issue of the higher rate, right? It's really getting them access to credit, okay? And that's the issue that's going to happen. The other big issue that's happened, this is particularly true in North America, coming to Europe as well, is that lender consolidation has been massive during these last sort of 10 years of Goldilocks economy, right? Every major bank has gone in and acquired every local lender, right? So now these smaller companies that had a great relationship with the bank down the street doesn't exist anymore. You call Citibank, they've never heard of it. You're just a line on the spreadsheet. You don't have any more relationships anymore. So what do you do about it? So one of the things that you need to do first off and foremost is that as an OEM, elevate creditworthiness as a key parameter in your sales funnel, okay? I've been shocked by some of my clients who have not done this yet, okay? The ground is already moved, okay? We haven't had to worry about this in a decade, right? I'm old enough to have sold equipment back, after the tech crash in 2000 and 2008, right? This was always a huge issue. So now, if your sales manager is coming to you say, oh, I got this great looking sales funnel. Well, is it real? Because can that customer actually get credit? If you're not all over that, I think you're really missing something. If your funnel is full of D-level tranche credit customers, how much is that really worth? I'm not multiplying that by a 0.9 probability at close, right? And sales ops and finance, and this is really what I think is your sort of, I call it weaponizing your balance sheet. You can help your customers, okay? Sales ops and finance needs to work directly with the lenders. Lenders are super open about their parameters for making a loan. Remember, they want deal flow, right? They want deal flow. So what can you do about it? Well, what do you guys think is the typical measure that a lender uses when they calculate default? Right? What do they think that your printer, your $400,000 Y4 printer is worth to them if the customer defaults? They use about 10 cents on the dollar. Because look, it's some specialized piece of industrial equipment, right? What the hell are they going to do with it, right? They're going to turn around and sell it for parts. What's it worth to you? I guarantee you've been in the business. You can take that printer back, refurb, but kick it back out again at 60 or 70%, right? So why don't you go to that lender and say, hey, look, if you're not willing to fund that deal for my customer, hey, here's what I'll do. If they default, I'll take it back at 40 cents on the dollar, right? That's a great way to help your customers. And by the way, has this cost you any money up front? Has any of the stuff I talked about cost any money up front? No. Right? These are all things you can be doing right now. Your balance sheet is now your differentiator, because when you're walking into some label press customer or wide format customer and 15 people have already been there and you can get that customer credit, you're going to get the deal. And here's the funny part. Does that customer at that point care what the price is? Do you have to discount? No. Right? You're the only person that can get them credit. Right? So fight that urge immediately to walk in with a discount to try to make up for the fact that rates have risen. If you can get your customer access to credit, this is a huge sales differentiator for you. Okay? And at the end of the day, if you can't get your customers access to credit, you're not going to make your numbers anyways. So I hope that was interesting. Fraser, thanks again for the opportunity to speak. I've tried to keep us roughly on track for lunch, but
I'm Marcus,
I was closer
okay.
minus, right?
Thanks very much, Ken.